All right, good evening, everyone. Welcome to the trade findings and adjustments for Tuesday, August 3rd. Pleasure to be here with you today. And I'm just going to point a couple things out in regards to yesterday's commentary. The comment was made, well, Kevin, what happened to GE? And I'm like, oh, it went through a stock split. I actually did not pay the attention I should have to the split that occurred because GE went to a reverse split. What a reverse split means is that instead of going for every one stock you have two or three, and the price goes down. For every 8 shares of General Electric, you went down to 1 share. Well, Kevin, what happens if you only had 4 shares? Then you were bought out. If you had, let's say, 100 shares and you had like a half a share, GE bought that half a share back from you. But for every 8 shares you used to have, you only had 1, and that pushed the stock price up to $100. I think it was actually $103 from where it was trading at. So the question to this group is, why do shares go through a reverse stock split? And already I know William had this, but for the rest of you, why do shares go through a reverse stock split? And William, we talked about it earlier, so I'm going to have you just, you're not allowed to say anything. No comments from William today. But yes, I see 2 coming in correct. Usually a stock split is because a company is having problems and they're trying to boost their stock price. You normally will see a reverse stock split when a stock is around $5 and they don't want to become a penny stock by being under $5. So you typically see a 10 for 1 or a 20 for 1 stock split. That makes the stock price back up to $50 to $100 and off you go. It's interesting because the comment that was made here was that because the 1 for 8 reverse stock split, the industrial conglomerate company proposed in March took effect, the reverse stocks have multiplied the price of stocks owned by 8, but it also reduced the number of shares they own by dividing by number 8. When the comment was, well, why did you do this? It was stated that, plain and simple, they wanted to be more in line with the number of shares that companies of their kind currently have. So what does that mean? As I went through, I'm pretty sure I saw more shares in Boeing, in Caterpillar, in 3M. So the short answer is, even if they are improving, it's a false way to boost their stock price over the short term. They shouldn't have had stock splits in the other direction in the past. So it's interesting. It's interesting to use something like this to boost your stock price, but they didn't exactly change the options. So as I was taking a look at my account, when I went to GE, I sold off half. They have non-adjusted stock items, options right now They might make these adjustments, or maybe it's time for me just to take some profits. My cost basis that I know is down at $2.02. They might go through some kind of reverse. I sold out some at 305 or 310. I've got at least a 50% return. It might be in my best interest just to sell out GE. Plus, it's one of the few that are a January option that has to move this year for me to be profitable. As I look through positions, I thought, wow, I like that I have January 23. I've got a lot I get to go through this year, but I'm going to go through why that could be a worry for next year. I'll go through that on Thursday. But pretty neat to see our positions heading up and to see General Electric actually make us some money finally. Under Armour had fabulous earnings. Instead of only making 6 cents, they made 24 cents. Instead of making 1.215 billion, they made 1.351 billion, an extra $140,000 more-ish, $144 million more, excuse me, than they should have made. So as we were looking at our positions, we said, okay, we've got Under Armour protected. They're looking fabulous. But we've got protection on Under Armour right now sitting at 121.50. We paid a pretty chunk of change for it, only worth right now, well, the mark's 155. Wow. So the question is, do we get out of it for a 7-cent loss, or do we adjust? And so I took a quick peek just to see what we could do for an adjustment. When I say I took a quick peek, the first thing I do is I take a peek at our charts. If I go to where we're at right now, Under Armour has a pretty good bounce up to 22.70. We have a high side of 26.45. But we've got a couple points here at 24, maybe even at 23.22, an R1 resistance level at 23.35. So pretty interesting. If you do a little bit of research, it has a chance to definitely get up to $23, maybe $24.50-ish. Maybe as high as 26. So the first instance that I'm looking at is, okay, I've got a couple dollars of still growth in Under Armour. Could you follow this trend? Where might you put a short put to make your money back? Well, we have our 50-day simple moving average, 2102, that coincides with a resistance point at 2190 or 2018. So we have some levels of support underneath Under Armour. Rich, you asked, what's the mark is 155 mean? Let me take a quick peek at what you're talking about. The mark is the most recent price that it was traded at. So $1.55.5 is the last price that this put traded at, which is currently just below our cost basis of 162. So that is what that mark price is. So we do have some upside opportunity on Under Armour, but it's a little sketchy with it close to being overbought. The good news is Under Armour can stay overbought for weeks. So there is a chance for Under Armour to run. Because of that, my thought process is tomorrow, if we see an up day on Under Armour, we're going to take off the protection and let it run. Another issue that had my decision made for me versus make an adjustment. When I look at the chart of Under Armour up here, again, a pretty good run up to 26 as expected. It's done it in the past, but I didn't see any upgrades just yet. 26 to 36 is a price. 34. You know what? Atlantic Equities, a no name, has them at only 24. Tolly Group, nowhere. Barrett only has them at 24. Piddle, which is a no name, is at 34. Morgan Stanley, 24. I would expect to see an upgrade from a reputable company. Jefferies has them at 35. Deutsche Bank at 28. 25 at Citigroup. I would expect to see an upgrade here by a reputable company. RBC at 26. I'd expect to see an upgrade here. So it'll be interesting to see if we get a couple upgrades in the near future on Under Armour. With that expectation, as I take a look, if I was to try to create a bear put on them, I'm only looking at $1.24. Might I be able to run it up? Possibly. I possibly could run up the September 3rd options and get more than the 155 that I could get out right now. I also looked at a calendar. Calendar 1 week out, I can only get $1.11 of credit. So as I went through a couple options, I could start out at a bear put and take $1.24 credit. But if you look at $1.24 versus a cost basis of $1.62, I'm still going to have 38 cents that I got to make up in some way, shape, or form. That the expectation is I'm going to have to roll, and will it stay bullish or will it stay above 21, 22? Will it stay in that price range long enough for me to take enough credit to completely pay off my puts? Again, looking back at our chart on stock charts, I don't see it. I didn't see it. I didn't see it being overbought. I kind of thought, I don't know if I'm going to get by with it. So as I looked at another option, how do I make up 6.5 cents? Or do I even have to? I don't necessarily have to, but I could sell those puts and I could add an option and go long on the position. It might cost me 16.5 cents. The problem is the limit price is $2.60. Do I think Under Armour will get to $24.50 to guarantee me a little bit of profit? If I go back to my chart one more time, 26, 24.70, 24.33, couple points up there, 23, 23, 23, 23. 23. I've got 5 points, 6 points it was at before, that it looks like it's probably going to have to break 23 before it gets up to 24. For that reason, I'm looking to not do an adjustment, not create a new position. I'm willing to take a 6 or a 25 or 30 cent loss on the protection because we ran $1.59 today. Because the upside might be around 23.30 as it stumbles, up to 24.50-ish, then up to 26. It's not usually going to come all at once, so I'm going to sit back. I'm going to sit back and I'm going to wait. What I am going to do, looking at the portfolio, is I'm ready to close my position here on GE. And I'm going to try to close it up on the high side at 295. So GE is going to be done. I'm going to send that in. I'll work through the other GE positions and get those sold off for people. Wow, Costco really is running nicely today. I ran a lot of changes last time. What was I going to point out today? First Solar. First Solar was the other one. What we spent $12.83 is now worth $16.07.5. Really, if I see First Solar get up to 17, I'm going to be tempted to take a position off, close it all down. Reason why is that short call is gaining a little more money than I expected. I like where the long call's at. I like the way we positioned it. If we take a look at where First Solar is at on a chart, not bad. It's up to 92. Not bad when you got in down here at 83. We're using support levels, but 95 was that high side. 91 in the past. We're approaching overbought. If I look at the chart as a whole, I'm getting tempted and ready to pull the trigger on First Solar and just take your profit from it. Could we let it go longer? We could, but when we paid $15.47, we didn't pay that. We paid $12.83. Getting out at 17, booking $4.17 just seems like a smart position for me to be in. So for those of you who might have followed along with First Solar, I'm looking to close this position at a limit price of $17, and I'm going to stick it out there for the next 60 days. So I'm looking to free up some cash and be ready. Kevin, when you say you're ready to free up some cash and be ready for what? September is historically the third worst month in earnings. And I take that back. Historically, September is the third worst month in the stock market by way of gains or losses. October is the worst. So my thought is, let's go ahead and take some profits, be a little cash ready or cash rich for earnings that are coming up or will come up in the future. With that said, Apple, for those that have the 135s, you're doing fabulous. I'm just coming back up to break even for my September 23 150s. It's one I'm going to sit on. I'm going to wait for quite a while. No reason to change anything right now. Good to let things just go. Baidu, I'm going to wait for earnings coming up on this one. But don't forget, we dollar cost averaged the 350s from 2 contracts to 4, and we paid off basically one of my original legs So as we look at a cost basis of 35, my true cost basis is only one contract. Sorry guys. My true cost basis on Baidu is only one contract is right around 35. Interesting to see how this one's going to work out. Good thing I went out to January 23 again and I can let that one go. Disney has earnings coming up next week. Interesting position to see where we're at here. I really should dollar cost average a second time since I am half of my cost basis. With that said, following that rule, especially prior to earnings, even though as I noticed California is starting to mask up again, time for me to make an adjustment here. And in all honesty, go ahead and buy a couple more at half of my cost basis. And off to the races I'm going. So for those of you who like to do a little more trading, a little more active in your trading, are looking to do some more option positions, really, I wouldn't initiate a new position, even on Under Armour with the way they had things going on right now. I would. Time to take the rest of the profits on GE. I start out with 10 contracts there. Dollar cost average Disney. And what was my First Solar? Looking to create a position to exit, an exit point on First Solar at a $17 mark, which would book about $4.17 of profit, about a 35% return. Any questions you guys have for me on our options portfolio? If there are no questions, glad to have you. Hopefully a little bit of help at looking at things today is going to be helpful for what we're looking at and what we see. Any comments? All right, guys. Hey, appreciate you being here for a quick little trade findings and adjustments. Appreciate you being here. Have a good evening. Now you'll see how I'm running our options portfolio that's strictly options. Guys, have a good evening, and I look forward to seeing you on Thursday morning. And Thursday morning is going to be interesting. Thursday morning is going to be another warning for something that we need to be paying attention to, especially through September, October. And actually, it's going to be two warnings. We're going to go over a little bit about our budget cap and how the Democrats and Republicans have to get along to, shocking, raise the cap on the budget because they outspent what they were going to. And again, I want to go over a little bit about taxes and the tax run that we could have at the end of the year. It really came to light in end of March, April of this year, but we've got to be considering the change in the capital gains tax. So two things I'm going to go over with you guys on Thursday morning. Guys, appreciate you being here. Pleasure to have you here, and I'll see you then. Bye-bye.